If you look at the Chinese economy overall, even though the data are highly questionable, the trend is very clear. This is an economy that's really stuck, and there doesn't appear to be any easy way to get it out of the rut that it's currently in.
And when it comes to youth unemployment, obviously there's a problem there with social cohesion potentially, but also consumer spending, I imagine.
Well, yes, consumer spending is an issue. The latest numbers we just got showed that in nominal terms, year-on-year spending was only up 2.5% just recently. And that may actually be an over-exaggeration, given they're saying the economy is growing at 5%. We're not quite sure exactly how bad the picture is because it is mixed, region by region, sector by sector. But overall, we are not seeing a strong recovery in consumer spending, which we thought we would, or we hoped we would, I should put it like that. And it doesn't seem likely that one will happen organically. Very quick key point. During COVID, when China was locked down, people were not given checks the same way that they were in Australia. No one has any cash buffer built up to spend. They really were doing it hard for a couple of years, and now they're coming back to a slow economy, no money in their pocket. It's not looking too good.
When it comes to the youth unemployment figure, there's estimates of around 20%, but it could be much higher than that.
Well, the figure that we had until they stopped publishing them was 1 in 5 of people between 16 and 24 didn't have a job. The whisper was that the number had gone towards 1 in 4, which is pretty dramatic. Now, we've seen similar things in developed economies before. We've had that in Italy, for example, and in Spain, where you get a younger generation that really can't find jobs. But pre-Brexit, they used to go and work in the UK. That's not obviously an option post-Brexit, and given the scale of the two countries between China and the UK or China and anywhere. So they understand they have a problem. They certainly want to solve that problem. I don't think ceasing the publication of the statistic will be the solution to that problem.
The property sector, of course, flows on from this. We've seen record property developer defaults and big names on the brink like Country Garden and Evergrande. It's a hard way back given the state of consumer spending and unemployment as we've just been talking about, do you think?
I don't think there is a way back. I think this is the important thing to recognize. I've been a very consistent voice saying that year after year, that while you're still on the upswing of higher property prices, that wealth effect, people then spending on the back of it, you can maintain that mechanism. But as soon as people realize property is overpriced and we can no longer afford it, which is the reality of the situation, and people don't want to speculate anymore, and you don't have any other form of stimulus coming in to put money in people's pockets, everything grinds to a halt. And then, of course, construction slows down, all manner of flow-through industries slow down, and you end up in an absolute rut. It's not a China-specific problem. Lots of economies would face this same issue if they didn't adapt or use different muscles at different times. But China, for very specific reasons, isn't able to or isn't willing to, and so is stuck in this rut.
How big is the contagion risk? Because we know BlackRock and Allianz are exposed to some degree, not to mention Chinese lenders.
Well, I don't think there's much of a contagion risk in the way that some people would fear. There is more of a Western involvement in Chinese capital markets today than there was 5 years ago, despite the fact that voices like mine were saying it was a risky trade that wouldn't pay off for them. So there are some people who stand to lose money. But generally speaking, this is a problem made in China, staying in China. But the flow-through effect is from a much slower pace of growth in China going forward for as far as the eye can see. And that affects everybody who sells to China, which of course includes a lot of people in Australia.
So far, there's been piecemeal stimulus, if you like. There was a surprise cut to one of the key interest rates yesterday and a lot of talk of support to the property sector, but there's been no big stimulus package. What have investors been hoping for?
Christmas every day. The same investors who were told, by relatively few voices, like the one you're hearing now, that this was a model that couldn't be sustained and that would go wrong at some point and risks would emerge, like to believe that there's a magical way out of this, which is basically just printing more money or borrowing more money. Because that's what we do in the West too. Every time we start to run into a problem, we scream at the RBA to cut interest rates and push up property prices. They would like to see exactly the same thing happening in China. But that's not really feasible. Interest rates are already very low. People recognize that property is unaffordable. They don't have any more money in their pockets. As I said, it's becoming a vicious circle. So what they would like to see is big fiscal stimulus. But the problem is the government has huge debts. Local governments have enormous debts which aren't even fully recognized, and consumers have absolutely enormous debts. So there's no appetite from any sector to borrow anymore sustainably. So if they're going to get stimulus, it's going to have to be the form we haven't seen, for a long time, which is direct coupons to consumers to go out and buy certain goods, and that could be a game changer. But it really, rips up the economic textbook even more. Or good old-fashioned money printing, which of course can be inflationary and could push down the value of their currency very significantly.
What are the economic priorities of Xi Jinping and Beijing? Are they going to stimulate the economy or just let it sort itself out?
Well, I think the important thing to recognize is that the current way of doing things in Beijing is not the way it was previously. They're not interested in growth for growth's sake, which is what Western portfolio managers are interested in. Everything's about the next 3 months. They don't really care about the long term. China doesn't think like that. And they fully recognize, if you read what they say in Chinese and in English over and over again, the inequality that has built up in their economy, the gaps between the rich and the poor, between different regions within China, and between the young and older generations, are unsustainable and dangerous, and they do not want to repeat what is being seen in the West in terms of social breakdown. They don't want to see that. If they throw in more stimulus of the form that Western portfolio managers want to see, you just get more of the same. Property gets even more expensive. People are left behind even more. So it's an absolute mess, really, on that particular front. But it won't be addressed via Western market-friendly mechanisms. What you're instead seeing is common prosperity, which is not fully crystallized yet, but an attempt to try and say, look, we're going to have lower growth going forward for a long period of time to try and narrow these gaps. Now, that doesn't solve all the problems by any means, but the key point is we're not going to be getting this Christmas everyday stimulus package, which the West desperately wants to see.
So is there a silver lining for investors then when it comes to that slowdown in China? Are we going to see the peak of interest rates come early in the West?
That's a really good question, and it's important to join these things up in exactly that manner. If China is stuck in a very low inflation, or some say deflationary environment going forward, very low growth, that would, on one hand, be deflationary, which means that for other central banks, for example, the RBA, perhaps, all things being equal, they can peak interest rates at a somewhat lower level than would otherwise be the case. But let's flip that the other way. Were we to get the stimulus from China that Western markets keep hoping to see, and we can't rule it out entirely, were we to see it, that would be very inflationary. Commodity prices would go through the roof. That inflation wave would come back to the West, and you would have to see higher interest rates here. So it's very much a zero-sum game, if you think of it like that.
Michael Every, great to get your insights. Thank you.
Thank you.